Welcome to the Kreston Menon podcast. Today we are talking about something most business owners think they already understand, but probably don't. It's debt. Not the kind that signals trouble, the kind that built highways, funded company takeovers, and quietly powered the UAE's growth. With me today are Bimal, who leads our debt advisory function, and Mr. Aravind Menon, our growth strategist. Welcome both to the podcast.
Thank you, Vignesh.
A lot of businesses approach the bank when they urgently need the financing. But what is actually the case? Is it they require to meet the bank when they are at the early stage of the business? Or is it during the growth phase? Or when they have only cash flow problems? What is the real ground scenario here?
See, when the businesses actually reach out to the banks when there is a debt issue, the problem is the banks will view as a business which has not proactively managed its funding. So it's more towards being a very reactionary situation. And the banks don't view it positively because client already is in trouble, and it's a lose-lose for the client because banks will not view it, as I mentioned, as a proactive business, and the client may lose the particular contract or the particular order for which they need funding. So my view is that the clients should have sort of a debt strategy in place. They know what kind of growth they are planning to have during the course of the next 12 months and what kind of order book they are looking at, what contracts they're going to bid. So they need to know where their funding is for getting these orders in. So I believe that a debt planning should be done at least a good 12 months before, or let's take like you do audit for a year. Similarly, debt planning should start the previous year for the current year.
Can you actually walk us through how borrowing increases the returns?
See, borrowing increases the return from a purely opportunistic point of view. That means if you actually use your funds to run a business, then your scale of growth would be very limited. In terms of when you use a portion of your fund and use the remaining as debt, then your business can almost double or triple in size. Yeah. Also, debt is needn't be expensive. When you divest your fund and use it as an investment, you could earn more than what you pay as interest for debt. So in that scenario, I would always say that a business should have a healthy mix of equity coming in and use debt which is available in this market at a reasonably good cost.
And that is always a good thing. So if you want to grow larger, especially in most markets, you need to take up debt. So being risk averse and not looking at debt as an option sometimes limits the growth of businesses. And we've seen it in a lot of cases.
So what happens when the debt goes the other way around, when the debt goes bad or when it actually goes wrong? What is actually going wrong?
See, the debt going wrong is not per se because of the debt. The debt going wrong is how the company is utilizing the debt. For example, say the company has taken a loan for funding, say, a project like a construction cost. But instead of using it for that purpose, which would give it return, if they're going to use that particular debt, the money which is coming in for an operational cost, like paying salaries, for example, then there is a wrong mapping of debt. So that is not going to give anything in return. So it's very important. The reason why the company is taking loans from a bank or taking any kind of credit facilities from a bank and utilizing it for the right purpose. Also, clearly understanding that the company wants a loan, but gets a loan at an interest rate which is exceeding their repayment capacity, or a tenor which is exceeding their ability to pay it over the monthly repayments. So in those cases, there's a big disconnect, which would lead to a debt going into a default. So it's very important to have the terms and conditions clearly mapped out when you're taking the debt, and it matches your repayment capabilities.
Okay, since you're talking about the not utilizing the debt for the actual factors, so when businesses approach you, what mistakes do you actually see? Is it is the management unclear of the usage of funds? Is it massive projections? What are the real mistakes that you see?
Now, See, mostly it all comes down to the first question that you brought here. That is, when is the management actually approaching a bank for the debt? So, if they're approaching it as a last cost resource at the last point of time, then there's no clear planning. So, they will take any debt which comes to them. Maybe the debt is not even suitable. The terms and tenors of the debt is not at all suitable for the business. Still, they end up taking it to just bridge whatever the cash flow issues.
So the
were there.
business could also have unrealistic projections.
It could have.
They don't
unrealistic
know what to
projections.
keep as a collateral. Maybe there could be a too much reliance on the collateral.
Yeah, that's very realistic also. And generally, when we look at the market, it's a very common scenario that this happens. So there are multiple different types of debt. So you need to be very sure on what type of debt and why you want to take it up also. So if you're looking at something like growth, then you can specifically maybe risk a lot more than something like maybe a operational costing, maybe like a working capital loan, or even like something like an overdraft. So it depends on the comfort level of the company. So ideally, depending on the comfort, you need to see how much visibility you can get with the banks.
Since we are talking about the different types of loan, how does a company decide on that aspect? Whether the company needs a term loan or whether it needs a working capital? Maybe it could be a loan for acquiring a company. So how do they decide on that? Could be a Muraba as well. There are multiple types of Islamic finances as well. So how do they come at a decision?
See, the banks have very tailor-made credit facilities for different purposes. For example, there's a term loan which can be 5 to 7 years. Say you want to build a manufacturing unit, then you'll naturally go towards a term loan. Say if you have a project in hand, as a contract or a subcontract, then there is a project-specific facility limits, which is a bonding limits that you have, the trade limits, the PPC discounting limits. You're tailored to the particular project and self-liquidating. Then there can be companies which are in the business of trading. So they would definitely need LC limits, trade limits basically. There can be operational limits which are required, like short-term overdrafts, check discounting, which is for mostly operational reasons. See, if a company wants to opt for an Islamic finance, then UAE has both conventional financing and Islamic financing. There are banks which are catering specifically for Islamic financing, and there are conventional banks which are offering Islamic finance also. So if there's a requirement for a Sharia compliant banking product, then there are options available in the market for that.
Okay. Now, since we've covered different types of debt, let's see what debt restructuring looks from a business perspective. When does a business need to restructure their debt?
See, there's two levels of restructuring we can talk about. One is a healthy company going for something called a debt optimization. For example, they have a splintered number of banks which they have. Maybe a company has moved from SME, which started an SME. And there's some banks there. They moved into mid market. There are some banks there. Then moved into large corporate. There's some banks there. There can be a disconnect between what a particular bank offers them. Maybe they're still at an SME level banking when they're actually a large corporate. So that's one way of optimizing where we can come in and bring them up to a certain category within the banking where they can get better limits, better negotiation power with the banks. The second thing is varying levels of facilities with varying terms and conditions. So there can be an optimization bringing these onto a uniform platform for the management of the company. Also, it's easy because the interest rates are mapped almost similarly in banks. We can bring that. We can have that lead the discussion with banks and do a peer-to-peer comparison and bring it to a certain level. And there is restructuring when there's an issue for the company. Now that restructuring would require a proper plan to be brought in front of the bank in terms of getting the company's cash flow or order book for the next 12 months or so, understanding what is the repayment capability, and if there's a debt which is more than that, then getting the negotiation on with the bank to either increase the tenor of the debt or what we call a haircut, shaving off a part of the debt, which some banks will be fine to get it paid off. So there are different strategies which we can adopt based on how difficult the situation is for the company.
Okay, so will you be able to walk us through how a disciplined, proactive debt monitoring could look like from a day-to-day business perspective?
The most important thing is the bank obligation has to be paid by the company. So whether it is a due coming in within 60 days or 30 days, or a repayment plan which has several tranches of repayment to be paid, it's important that the company has the cash flow to meet those repayment obligations. Because if they default, there are clear rules here. Depending on the number of defaults they have, then the profile of the company goes down with not only one bank, because we have monitoring in the form of Etihad Credit Bureau, central bank reporting. So the ability to borrow in the future with other banks would also be severely curtailed. So this is the reason why it is very important that debt monitoring is actively built into the company's accounting or CFO level, reporting structure. And also, banks take very high importance on covenants and conditions which are placed in their offer letters. It's very important that these are not breached. Like this, there could be a debt equity ratio to be maintained. There should be a current liquidity ratios to be maintained. So the banks have clarity on this when the audited financials are provided. And if there's a breach, then that would severely impact the client's ability to borrow from a particular bank, or their facilities can be sort of pulled down by the banks.
Let's talk about the hard fact here. You've seen what the region has gone through for the couple of months. How did banks react to at the initial phase, and what is the current situation of the banks?
So yeah, we were in the market at that point. So it was very visible from our perspective to see how the bank's perspective completely changed. So initially, when we had clients come in from outside UAE who want to set up businesses here, it was much easier for them to approach the bank and arrange finances. It would be a much easier process for us also to get them that finance. But nowadays, we've seen that risk appetite for the banks has also changed a bit. Most banks are also in a wait and hold mentality. From central bank's perspective also, they have tried to relax the tension in the market, and what they've done is more for the local market as such. So for the local investors and people who want to access debt in the market, it's getting better for them. But for foreign investors, it will take some time.
Just to add on to what Aravind just said, so the initially banks were more when this happened, banks were more looking towards their existing clients to see that they don't go into a default, support them. So first focus was there than say a completely new project coming in. But thankfully, central bank had clearly given a stimulus package at that point of time to all of the banks to shore up the necessary capital to support the existing clientele of theirs. So things went very smoothly. Initially, as Aravind clearly mentioned, the focus was mostly on existing clients than on a new one coming to the books or new one coming into the country. But slowly, I think we are seeing that changing the bank's interests again. We have inquiries from banks. When we approach the banks now, we're seeing the appetite sort of slowly resurfacing back to how it was before the issue started.
Since you are talking about the relationship, a quick question just popped up in my mind. So earlier, if I remember from people speaking, banks relied or may have relied on or heavily relied on collateral and banking relationship. What has actually changed with the banks? Because now they are focusing more on cash flows. They want more visibility on the cash flows. They want visibility on the management reporting. They want probably they want to see if governance is there in an organization. So what has actually changed?
See, the collateral-based lending, collateral is not something that the bank views that, we will just liquidate if things go wrong and just pay off the debt. It doesn't work like that. It's more of a comfort. Even from the bank's point of view, even if they take a collateral, it acts like a comfort because actually selling off something, the banks are not in the primary business of selling off a property and then getting a funds from there and then paying off the debt. So this is more of a comfort, and this comes into play when mostly the balance sheet is not strong or the client is fairly new into the market. Client is venturing into something new which they have not done before. So the banks need a comfort for which they take a collateral. Now the main appetite of the bank is to see that a client knows what it is doing. For example, a contractor comes in, the contractor has to have bonding limits, performance bond, advance payment guarantee. Now, a bank would be very careful if it is lending to a contractor who's never had a history in this particular line of business. But if you bring in a contractor who's been doing this for a really long time, have an active project pipeline right now and have executed in the past, then the banks see it as a very big positive. Then the other things that the bank considers, obviously, the balance sheet is very important. A lot of governance comes in from the balance sheet itself. There's a view from there. And if a bank goes and sees the treasury department of a company and understands their qualified people working there, or they're engaged with somebody handling their debt for them on a permanent basis, where we can also come in as a debt consultant and we are actively managing the books of the company on behalf of the CEO of the company. So these are things the bank views positively. And as also the cash flow is very important, the bank needs to have clarity that whatever they are lending to the client will be paid on time. So yeah, the focus has shifted. Collateral has always been a comfort more than a security.
And generally, I feel like banks also want you to grow as a company. So when you're taking those kind of, when they're giving you that kind of a facility, generally they want you to grow in the market. So I think the new mentality has shifted a bit into that direction. So here they have a general understanding of what the customer requirements are, and they do try to work with the client a lot more.
I believe probably if the business has got everything in place, like proper structure and documentation, believe banks will be in a much better position to to provide the loan to them.
Even if our job again as debt advisory business in Kreston is to also help the clients bridge that gap. Now, what the bank is looking for, the bank may be looking for a set of items. We are clearly aware of what they're looking for. The client may actually have it, so then we can get that picture to the bank. And if the client is not ready on it, we can make the client ready, provided they are in the right line of business, and then place it as a package to the bank, which would enable them to acquire the limits or the funding at the right pricing in the right security structure.
So since you've brought how the firm can help clients for the debt part of their balance sheet, can you just explain on how this can be synced to the other services provided by Kreston?
So
And also how integral is this part after syncing it to the other services?
So we do have consulting and advisory function within Kreston. So one thing that we've always seen is when clients do come into this market, or they generally do a feasibility study to enter this market, and normally debt is always a part of that requirement. So one thing that we always can help the client with is that we can connect the transaction advisory that we do in terms of the feasibility study, and then we can give them that an overview of which banks would be comfortable depending on the bank's mandate, and which bank would be more comfortable with taking up this customer. And that's the gap that we can bridge just from a transaction advisory. Then we have upper level, higher level requirements, something like a mergers or an acquisition that can happen. In those kind of cases, debt is always a part of the requirement. And when valuation comes into the picture, we provide that direct assistance to the client. And again, we are able to take them to the right bank for the right price, and we can get them the best rates. That's what we can offer from our perspective.
Also, just to add on, we view Kreston Consulting and the wider Kreston Menon group as a one-stop solution for a client. Say somebody, just to give an example, somebody who's come to us looking for acquiring a company, say we can find the company for acquisitions via the buy side, the sell side. Then there's an acquisition finance element coming in. So we can arrange with the banks. We are well connected with all the banks and who have appetite for these segments. Bring it on the table with the right rate for the client. There is a due diligence element coming in. There's a valuation element coming in. There's a feasibility element coming in, which is all covered with transaction advisory from Kreston Group, Kreston Consulting. And also, obviously, once the clients are onboarded, there is an audit requirement coming in. There's a tax requirement coming in, which is the primary business of Kreston Menon Group. So it's all in all, there's a total synergy.
Yeah, we are like a one-stop solution essentially. So we can get the client from incorporation to where they want to be in the next 10, 15 years
Yes.
as long-term part.
Yes. That's a great place to end the conversation, Bimal and Aravind. Thank you so much for being here. Thank you for your time. We've covered why debt isn't the enemy, what debt actually is, how to become bankable, choosing the right facility, whether it's Islamic finance or conventional financing, debt restructuring, the UAE's own relationship with debt, how the regional conflict has played out, and where things stand today. If this conversation has shifted how you think about using debt in your business, that's exactly the point. To speak with Kreston Menon's debt advisory team, visit our website or reach out directly. Until next time, signing off.